Everybody, thank you for joining the ACA Small Business Bootcamp and Resource Collective for this Thursday, April 1st. Even though it's April 1st, we're not going to have many jokes on here, but we appreciate everybody joining us. I'm Robert Theobald, the Small Business Ombudsman and Vice President of Small Business Services. We like to always start these boot camps thanking all of our community partners. We could not do these boot camp sessions without them. We've got a great network of these community partners throughout the state that have helped provide their expertise, their time, and their effort to provide the training for the boot camp sessions. So for those that are new, the Small Business Boot Camp is designed to help small businesses work through the COVID crisis. We were just talking this morning. We started this on April 27th of 2020, so we are almost at a full year of doing the boot camp sessions. And they are a statewide initiative supported by all of our community partners. Aside from the boot camp, we have our resource collective, and I will touch on that here in a moment. So the Small Business Boot Camp and Resource Collective website is a great website to favorite in your web browser and access often. On this website, you can see the upcoming webinars. Excuse me. The upcoming webinars, register for them. You'll have a link to the Resource Collective, and then one of the most valuable items on this website, if not the most valuable, is the archive. And we record every session and we post them in the archive. And you can go back and watch any of the sessions you've previously been on or missed and want to go back and review that material. We've done over 140 boot camp sessions, and so we have a tremendous library of knowledge available at no cost to go back and review and utilize. Additionally, as I mentioned, we have the Resource Collective, and the Resource Collective are the tools and guides brought to you by our community partners to help small businesses work through this crisis. These are just a sample of some of the guides and resources available on that website. As you can see, we have guides for unemployment insurance, guides for safe workplace, safe retail, information for the construction industry, for manufacturing, cosmetologists, restaurants, etc. So a lot of great information is available on the Resource Collective webpage. Additionally, we have our Arizona Commerce COVID-19 Arizona Business Resources page. And on this website, you can find business guidance. We also have a link to financial resources where we keep up to date as often as we hear of grants and funding opportunities or lending, that we list it there so businesses know where they can find the financial programs that are currently going on. Additionally, the ACA has a number of programs that help support small businesses. Our small business services, we can help guide you and help you navigate through the SBA, work with the SBDC or SCORE, connect with local banking contacts if you're looking for funding, and share some of the latest developments. Additionally, our workforce division can work with you as you're looking to hire new employees, crosswalk employees, or do some training programs to upskill your employees. They have programs for all of that. And then our Arizona Manufacturing Extension Partnership, Arizona MEP, can help manufacturers with their manufacturing needs during COVID, do emergency planning, do lead consulting or lean consulting if you're looking to improve the processes in your business. They have a number of different programs to help the small to medium-sized manufacturers throughout the state. Additionally, if you're looking to start a small business or start a side gig, oftentimes you don't know what licensing or registration or compliance requirements it may have. And so we have our small business checklist, and it's an interactive online guide to help people identify the registration, licensing, and compliance needs on the local, state, and federal levels. And then finally, the last website I want to talk about is the state's COVID-19 information and resource page, arizonatogether.org. There's a lot of great information related to COVID-19 on here, and keep an eye on it. Now, transitioning, we want to talk about some updates. And the first thing I want to share is starting today, immediately after our boot camp session is the opening session for Startup Together AZ. And this is a combination of a number of different startup programs that would go on throughout the state. They joined forces to create a month-long month of activities in April for startups, both tech startups, Main Street startups. So a lot of small business information. There's a number of different programs that you may want to take a look at that support your business on startuptogetheraz.com. A number of our boot camp sessions will be related to that as well, looking at ways to start your business or marketing for a new business and other items. So join us for those. Additionally, the Shuttered Venue Operators Grant, this is just a reminder that the application portal opens on April 8th. And the link I've included here is for the application, so you can look at it and start working on the things that it requires. It's got some in-depth stuff and things you have to do. So please take a look at that. Also, the SBA had a recent webinar on the Shuttered Venue Operators Grant. And if you can get that recording from their website, there's a lot of great information walking you through that application process. Also, the SBA announced that COVID-19 economic injury disaster loan limits have been increased, and they will be reaching, the SBA will be reaching out to businesses directly on how to apply for that limit increase. The IRS also extended the tax deadline to May 17th. And then just recently, in the last day or two, the president signed a new act, the PPP Extension Act, and that will allow the PPP loans to continue on up to May 31st of this year. So with that, I want to talk about our upcoming sessions. We've got for next week and the following week. So we've got some of these start off with that Startup Together Arizona programming. On Tuesday, we've got our no-cost business support programs. It's going to be a great panel session with SBDC, SCORE, and the Women's Business Center. On Thursday, we've got a session on how to start your small business in Arizona. The following Tuesday, April 13th, we've got a marketing session on how to prioritize your marketing efforts as a new business, brought to you by the experts at Mountain Mojo Group. And then on Thursday the 15th, we've got Robin Reed, the president and CEO of the Black Chamber of Arizona, talking about positioning your business for success. And Robin's been on with us before, and he's a phenomenal speaker, and it's going to be a great session as well. So with that, we're going to turn the time over to CariAnn Todd. While CariAnn's getting set up, I'm going to stop sharing my screen. We're going to do a quick poll. We've got 4 questions we're going to throw up on the screen, and please answer those. We'd appreciate it just to get some of your feedback, but Lisa's going to go ahead and start that poll real quick. So the first question is, did you receive an economic injury disaster loan?
Hey, Robert, my share your screen icon just disappeared.
Oh, it might not be available with a poll up. So
okay. All
right, let's go to the second question, Lisa. Have you received a PPP loan? All right, we'll jump over to the third question. If you received a PPP loan in 2021, which one was it? First draw, second draw, or did not receive a PPP loan in 2021? All right, and then the last question. Then, are you planning to file for the employee retention credit? All right, so we're split there, 50-50. All right, thanks for participating in that poll, and CariAnn, it is all yours.
All right, I'm just waiting for the share screen to come back. Not sure, there it is, okay.
Also, while she's pulling up her screen, if you have questions, please post them in the Q&A box. We use the chat for other stuff, and then we'll use the questions that you have about PPP or ERC in the Q&A box. I also do want to mention that we have Brian Quijada from the SBA on with us, and he will also participate in the Q&A at the end of the CariAnn's presentation.
All right, just want to say thank you to everyone for joining today. Like Robert said, it's been almost a year since all of this started. And so here we are a year later, and there's been so many changes. I mean, the program has morphed significantly over the past 12 months. So the only thing I've really learned from it is if you just wait and are just patient, is if you can try to make yourself be patient, you know, patience kind of seems to favor you. So, you know, because of the rules constantly changing, those who have been waiting longer to apply for forgiveness, those who have waited longer maybe to even get a loan, you know, in a lot of those cases, being patient has been favorable. So I know it's hard to be patient when you're, as a small business owner, you're going through all the things that you're going through. But I think it's beneficial to just kind of sit back and not get too excited and kind of get through it and do everything right through the process. So anyway, okay, so this presentation is based on what we know as of yesterday. And I clarify that because, as you know, it keeps changing. So if you come back to this presentation at any point in time, just know it's as of March 31st, 2021. So anything that changed in the law after that is not going to be included in this presentation. So, okay, PPP2. So when Robert contacted me about this, he said, well, let's do this presentation in April, and hopefully by then they will have decided what they're going to do on PPP2 and extend it. And they did 2 days ago. So the PPP2 was extended on March 30th. It extends the application deadline through May 31st. So if you were, you know, kind of scrambling or you didn't get your application in by yesterday, and a lot of you may not have been able to do so because the lender stopped accepting applications, a lot of them in mid-March, because they wanted to have time to get the applications processed by the March 31st deadline. So when Congress passed this law, they not only extended the deadline to apply, they are giving the SBA 30 days to process everything that's in the pipeline on May 31st. So, but you have to get your application in by May 31st, and then there's 30 days after that to make sure you get through the error checks, if there are any, and get to the point where it actually approved. So that is in effect now. In general, speaking about PPP2, any eligible business who did not receive a PPP loan in 2020 is eligible to apply for and receive a loan under the same terms as round one. So round one had its own specific set of rules. So if you've not gotten a PPP loan before, you're subject to those rules, meaning you're not subject to the 25% revenue reduction requirement that's part of a second draw loan. And then if you happen to have gotten a loan in 2020 and you returned it because at the time the rules were not favorable for you, which I actually had a small business owner who did that. They got a PPP loan. They also got an EIDL grant. And at the time, the interplay between those two programs was not favorable for them. And they were going to have to actually pay back over half of it. So they returned their PPP loan, kept their EIDL grant. And then now in 2021, they're applying for the PPP loan again. So that is an option if you happen to have gotten one and returned it. And then any business who did receive a PPP loan in 2020 is able to apply for and receive a second PPP loan as long as you meet the requirements for round two. And these are referred to as second draw PPP loans. So if you're on the website for the Treasury setup, or you're looking at your lender's portal or whatever, They are designating these as second draw PPP loans, and they have slightly different rules. So make sure you are applying for the correct one when you get into the portal. So requirements for a second draw loan, you have to have 300 or fewer employees per location. Round one, it was 500. You have to have used or will use all of the first PPP loan. And I'm pretty sure everyone has probably used their first PPP loan by now, because the window closed for those in June, I believe. So I don't think that's an issue for anyone. You had to have had a 25% decline in gross receipts in any quarter in 2020 when compared to the same quarter in 2019. So you just look at your gross revenues for a particular calendar quarter. So let's say it's the second quarter is probably the quarter that most people are seeing the decline. You look at your second quarter 2020 gross revenues, compare it to your second quarter 2019 gross revenues. And if there's a decline of 25% or more, then you're eligible for this PPP second draw. The second draw, the PPP2 also added some additional 501c organizations. And then I believe the most recent tax act that came out, there's so many now, I can't even keep track, the ARPA, I think it even added more 501cs. So if you're in that category as a not-for-profit, you kind of really need to drill in and see if you're eligible now, because there's a lot of different kinds of not-for-profits. So make sure you fall into an eligible category. So here's an example of a revenue test that I put together. So you can see in the second quarter, they're down 32%. So they meet the first test, which is a 1 quarter year-over-year decline in revenues. But I kind of want to draw your attention to this certification. So on the application, you have to initial this line. It says current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. What that means is still never really been defined. I kind of interpret it to say that you're getting this loan because you really need it. Not only do you qualify for it, you also really need it. And sometimes those are two different things, and they may not always be. If you qualify, you need it. So it's just something to consider when you're filling out that application, because these loans will be audited. Not all of them. Every loan over 2 million is going to be audited, but below 2 million, they're using a sampling application, and they are auditing a sample of these loans. And they're looking at your paperwork, and they're making sure you have all your ducks in a row and all that together. So anyway, it's just something to consider. Okay, the loan amount is going to be 2.5 times your average monthly payroll, unless you are in the hospitality industry and you have an NAICS code that starts with a 72. For the most part, that's restaurants, but there are other industries that qualify for that. You'll get 3.5 times your average monthly payroll. Your average payroll can be based on calendar year 2019 or the 1-year period before the date of the loan. You're able to choose which period you use, and the overall maximum loan amount is $2 million. So recent legislation changed the metrics for Schedule C applicants, and this has been all over the news, and it's been met with a lot of relief, and it's been met with, people are happy that this change has come. The only problem is it's not retroactive, and there's no provisions right now for it to be retroactive, or even to be retroactive for people who already have an application in the timeline, in the pipeline. So right now, our understanding is it only applies for people who filed their application after the legislation was effective. So basically the change was, instead of using net income on your Schedule C, you can use gross income from your Schedule C. And that's a huge difference for most Schedule C people. So for a Schedule C applicant who has no employees, the formula is basically gross income on line 7, divide by 12, multiply by 2.5, with the max loan amount being $20,833. So here's a sample Schedule C. This is what a Schedule C looks like. And so you can see line 7 is gross income after cost of goods sold. So if you sell if you're in a service industry, like this Schedule C that I prepared is a person who's like a consultant. So they don't have any cost of goods sold. They don't have returns and allowances. They just get consulting revenues. But if you make or sell a product, then the gross income factor they're using is after cost of goods sold. So make sure you know it's line 7 here. Whoops, line 7 here, not line 1. Okay, so in this case, this person would take line 7 divided by 12, multiplied by 2.5 to get their loan amount with a maximum of $20,833. So for them, it would be $20,833 because in this case, 150,000 divided by 12 multiplied by 2.5 is too much. Now, what would their loan have been in the original formula? In the original formula have been based on their net income. So if we pop back over here to this sample, you can see their profit or loss for this one is 68,000. They don't have any other expenses below this line. So it would have been based on this bottom line number here, 68,000. So under the old formula, they would have gotten 14,167. So this change in the law increases the PPP loan by over $6,000 for this particular example. So that's how much of a difference it can make. Okay, so what about if you're a Schedule C applicant and you have employees? So the math is a little more complicated, of course. So this is basically the formula. You take that same line 7, and then you're going to subtract out your wages, your health insurance, and your profit sharing contribution down in your expense section. And you divide that by 12. That comes up with your first number. And then you compute your average monthly payroll. That's your second number. And then you add those two together and multiply by 2.5. So let's go through an example here. So here's another Schedule C that I prepared. And you can see in this case, they've got the same 150,000 in gross income. They've got 5,000 on line 14, 2,000 on line 19, and 50,000 on line 26. So if we go to the math here and follow the math, get their adjusted gross income, divide that by 12, that's 7,750. That's our first number. And then you take their average monthly payroll, which basically comes pretty much straight from the Schedule C, right? It's those 3 lines that we just added together divided by 12. That's your average payroll for this Schedule C period. So you take the sum of those two numbers, the owner's eligible piece, and then the average monthly payroll for your employees, add those out, multiply it by 2.5, that's the loan amount. If this was a restaurant or something other hospitality that had the 72 code, you multiply it by 3.5. So that's kind of an example of how the math works for this new Schedule C formula. Here's a link to the SBA form for this application on the SBA website. Now, realistically, a lot of the lenders have their own portal, they have their own forms. They pretty much look like the SBA forms, but not always. They're set up by their IT departments to gather all the data. So they might not look exactly the same, but they're supposed to be gathering the exact same data that is on the SBA forms. So if you prepare the SBA forms as a prep for getting ready for your lender portal, I think that would be great. You should have all the information that you need. Okay, so there's some questions about Schedule C over here in the Q&A, so I'm going to try to address those. The first one is, will there be consideration to apply the new Schedule C formula backwards? So right now the answer is no. There's no provision for that. It was only for applications filed after the change in law. So that unfortunately is not happening. Okay. I received a PPP loan based on my 2019 Schedule C for forgiveness. How do I get forgiveness? Okay, so this is Dave's question. So if you're a Schedule C without employees, basically when you go to get forgiveness, you give them a copy of that same Schedule C, and you by definition get the loan forgiven. The only time it might get awkward is if you remember, a lot of people were applying for PPP loans in the first round in April, and you may not have had your 2019 Schedule C completed yet, right? You might have been using a draft, or there were actually some lenders that were allowing you to use your 2018 Schedule C, which they technically weren't supposed to. But when you're a sole proprietor with no employees, you just have to provide that Schedule C during the forgiveness process. There are some lenders I've heard that are asking you if you, quote, paid yourself, but I don't really understand that, because as we all know, sole proprietors don't pay themselves, right? They take money when they need it. They use it when they need it. So anyway, that's my understanding of how the Schedule C is supposed to work, is you just use your Schedule C to get forgiveness on the forgiveness application. Let's see, where is Arizona at on PPP loans as taxable income? They are not taxable as far as I know right now. I know the legislature is still on the fence on a lot of things, unemployment, the tax filing deadlines. But I believe, I know we've been preparing returns on the assumption that they're going to conform. If they do come back and don't conform, that would be kind of a nightmare for everyone in the tax prep industry and anyone who's filed already. So anyway, my understanding, we're expecting them to conform. What exactly do I need to prove owner's compensation for forgiveness? Write a check to myself. So I think I answered that before, is based on the instructions, you just have to provide a Schedule C to show that your owner's compensation was sufficient for the forgiveness if you're a Schedule C. Okay, I think that's all the questions I have right now, and those were all Schedule C related. All right, so we're going to move on into forgiveness, and I want to make sure, so we're already at 9:25. There's a lot of slides in here, and there are slides at the end on employee retention credit. So there's I don't know if we'll get to employee retention credit, because I want to make sure we're focusing on forgiveness. So if we don't get to those, you can get them in the download. But forgiveness it's simple and it's complicated, is basically the best way to explain it. You know, along the, and the reason it's complicated is they keep changing it. And there's just so many different metrics that go into it in order to compute what your forgiveness number is. So the applications have been revised as of January 19th to incorporate all the changes from the Consolidated Appropriations Act. In this presentation, the changes from that act, which was signed right after Christmas, are highlighted with a star. So you'll kind of see those as we go through. All the forms for forgiveness, the SBA forms, are at this website here. Same thing. You know, the lenders' portals are not exactly the same. They're more like an input screen, whereas the SBA forms are actual forms. But for the most part, I've seen working with clients is if you have the SBA form prepared and ready to go, you should be okay in your lender's portal. If they make you do it electronically in the portal, and they won't accept the SBA form itself. Okay, one of the changes is that the 3508S can now be used for loans up to $150,000. Now, if the 3508S was originally for loans under $50,000. And the best thing about that form originally is that if you were eligible to file it, you were not subject to the FTE rules. Okay, and the FTE rules are complicated, as we'll get to those. So that was great. So my hope, because the FTE rules are so complicated, is that when they extended the use of the form to loans up to $150,000, that they would extend that exemption. They did not. Okay, so you have this form, the 3508S, that can be used by two groups of people: loans up to $50,000 and loans between $50,000 and $1 up to $150,000. But the rules for those two groups of people are different. And to me, that basically just made it more complicated. They should have just left everyone else using the easy or the 3508, because in reality, that's the rules they're subject to. So I'm not a fan. I apologize to Brian at the SBA. I'm not a fan of this change of using the 3508S for the larger loans. It's just too complicated to boil it all down to one number. But anyway, they didn't ask me, right? They probably didn't ask Brian either, if I had to guess. Okay, so borrowers who complete the 3508S, but who meet the requirements outlined in the instructions to the 3508EZ may be exempt from the FTE reduction if they were unable to operate at the same level due to COVID orders. So the easiest one is restaurants. There's some retail that were restricted. If there's any COVID order from the governor or your local county or city that caused you to be unable to operate at the same level as you operated prior to February 15th, then you're potentially eligible for the 3508EZ, which includes not being subject to the FTE reduction. So that's a huge thing. But those who are not exempt must adjust their costs eligible for forgiveness by the ratio of employees during the covered period to employees during the selected base period. Okay, so but here's how the FTE boils down to. So your FTEs are full-time equivalents. If I work part-time, if I work 30 hours a week, I'm a 0.5. If I work full-time over 40 hours, I'm a 1.0. You have to do the calculations on all your FTEs. And if you had a decline, you have to basically penalize your total eligible costs. And we're going to go through the math on that. So I've got some slides on FTEs. So the basic FTE formula uses 40 as the base. I know that for a lot of health insurance and other things, 30 is the base for full-time, but for this program, excuse me, for this program, for calculating FTEs, 40 hours is your base. So you go through all your list of employees and you figure out what they are. Okay, and you can see an example of that here. There is a simplified method that is allowed. And basically the simplified method says if someone works more than 40 hours a week, they're a 1, and anybody who works less than 40 is a half. So if that's an easier system for you, you can use that system. Excuse me, it's allergy season, I'm not doing well. Anyway, so you can use this simplified system. The key is you have to compute FTEs for 3 different periods under the rules. You have to use the same method for all 3 of those periods. So you can't use this method for one and this method for another and work the math in your favor. You got to pick a system and use it for all the periods that we're looking at. So so that's what the first bullet is here. Owners are excluded from all FTE computations. So when you're doing the FTE calcs, do not include any of the owners. That's critical. So here's the math from the instructions. It says for each employee, enter the average number of hours paid per week, divide by 40, and round to the nearest 10th. Okay. And you have to do that for every single employee. You can't just take your total hours and divide, if you pay weekly, divide it by 40 and come up to a number. You have to do it by person, because as you know, each person, in a lot of situations, each person's hours change every week. So someone's FTE might change. So this is the math you need to use to compute your FTEs. So you have to compute FTEs for 3 periods. Okay, so the first one is the covered period. That is the period starting on the date you received the PPP loan, and then however many weeks into the future, maximum of 24. Minimum of 8, maximum of 24. So that's one of the changes that came out of the Consolidated Appropriations Act, is that you can choose your covered period to the maximum of 24, which gives you a lot of flexibility for your reporting. Okay, so once you define what your covered period is, you compute your FTEs for that period. Okay, that's period number 1. Then you also need to compute 2 other periods, and they're listed here: February 15th of 19 through June 30 of 19, and January 1st of 20 through February 29th of 20. So you've got 3 calculations of FTEs going. Okay, and these are an employee is an employee is an employee. So we're not, through this whole program, we're not talking most of the times about, you know, John in all 3 periods and Susie in all 3 periods. It's just whoever worked for you period 1, whoever worked for you period 2, whoever worked for you period 3. That's how you're computing your FTEs. These option 1 and option 2, these are called the base period. And so ultimately what you do is you compare your covered period, how many employees did I employ during the period that I'm spending the PPP money, compared to one of these 2 base periods, and you determine whether or not you had an increase or a decrease. So for example, if your 2 base period results are 10.5 and 6.8, you want to pick the smaller number so that you're comparing yourself during the cover period to a smaller base number. Okay, and they give you options for, I can list 15 different reasons why they're options, but the options are good because it works in your favor. All right, so let's say our FTEs was 8.4 for the covered period. I'm going to compare myself to the option 2, right? Because it shows I have an increase. If I didn't do the math and I had to compare them to option 1, it would show I had a decrease. So you can see the benefit of doing the math for all the periods to make sure that you get the most beneficial result for your business. Okay, so that's FTE. So that's the first quote, reduction, penalty, what you will, in the rules for forgiveness. So essentially what the FTE comes down to is if you had, let's say, a 20% reduction in your FTE, so the cover period compared to the chosen base period, then you would have to take your total eligible costs and you would have to take a 20% haircut off the top in order to determine whether or not you get forgiveness. So there's a penalty for not keeping your FTE count at the rate of one of those base periods. So if you're just now getting a PPP loan, you need to go back as quickly as you can and compute the FTEs on those base periods so you know what you're working with. Because mathematically you can overcome an FTE reduction. It's not a deal breaker. Because you have 24 weeks to work with. The loan formula gives you about 12 and a half, 13 weeks of payroll, really, when it comes down to it. So you've got a lot of flexibility. So FTE reduction doesn't mean you're not going to get 100% forgiveness. It probably just means you need to include more costs on your PPP application and maybe go the full 24 weeks on the covered period in order to get there mathematically. I've had several clients that have had FTE reductions for a variety of reasons, and they all got 100% forgiveness except for one. And the one that didn't was in construction and they just didn't have any work. They were a home builder. They didn't have any homes in process. They didn't have any new home starts, and they had no work for the employees. And they just, the employees moved on, or they laid them off or whatever. But we're consulting with about 200 clients at BeachFleischman, and they're the only one I know of that so far hasn't gotten 100% forgiveness despite an FTE reduction. Okay, so switching gears, let's talk about wage rates. So in addition to making sure you keep your FTEs up, the program wants to make sure you're paying everybody almost as much as you were paying them before. So there's another penalty if you decrease wages by more than 25%. And so what we're talking about here is base salary and base hourly rates. We're not talking about, commissions that fluctuate. We're not talking about bonuses. We're talking about the base rates that people get paid. So here's my example. Joe's full-time and you pay him $1,000 a week before your covered period. But during the covered period, you cut his salary to $650, even though he's still working 40 hours a week. So here's the math for the penalty you get for Joe if you choose an 8-week covered period. So under the rules, you're allowed to reduce Joe down to $750 without penalty, but you reduced him to $650. So that's $100 per week penalty that's going to be assessed on your forgiveness calculation. So for this employee, if the covered period was 8 weeks, the penalty would be $800. If you're reporting 16 weeks for this employee as your covered period, the penalty would be $1,600. So the penalty is tied to your covered period. Same kind of example for an hourly person where, we took Mary from $20 down to $13 per hour. Here's how you would compute the penalty for Mary. I'm not hearing a lot of people cutting people's wages. It's very rare from what I've seen for people to have had wage reductions, but it is something that you're required to calculate and assess whether or not you mathematically reduced anyone's wages. Okay, in the revised application instructions that came out in January, it says the hourly rate or base salary that you're using as your base for that calculation would be the most recent calendar quarter in the covered period. So that's something to think about if you just got a PPP2 loan. And let's say you got funded in March, The most recent calendar quarter you'd be comparing to would be fourth quarter 2020 as your base for doing that calculation for PPP2. So make sure you read those instructions really closely if you have reduced wage rates, so that you do those calculations correctly. Okay, those are like the words that I did all the bad news first. So we're going to roll into the happy news, which is the covered costs themselves. So what are all the costs you can include on your PPP application? The original 4 from the CARES Act are payroll costs, rent, interest, and utilities. And we're going to talk about all of these in detail. The Consolidated Appropriations Act in December added 4 new categories, and they're not as straightforward. So essentially I just pulled the definitions straight from the application so we can go through those. But there's 8 categories of costs that you can include. So payroll costs is the same definition that you're using on the front end when you got your PPP loan. Wages, tips, other wages, group health insurance premiums, the employer portion, retirement contributions, the employer portion, and your SUTA taxes, state unemployment. That's all included in payroll costs. You cannot, however, include in your PPP application any wages that were claimed under the first, I can't even say, I'll just say FFCRA because everyone knows what that is. So if you had any employees that utilize FFCRA, you have to exclude those wages from your PPP application. The second thing is if you're using any wages for the employee retention credit, you can only you have to pick a program. ERC and PPP are separate, but you can't double dip on wages. So if you're going to claim some wages for ERC, that's great, but you can't use those exact same wages in that same pay period for the PPP program. So this takes a lot of if you're eligible for ERC, like if you're a restaurant and you're eligible for ERC the whole time, there's a lot of give and take you can play with on these 2 programs and really maximize the dollars. But you have to be really careful that you're not double dipping on anyone's wages. Okay, so non-payroll costs. So rent for real or personal property. So your building, your office, or equipment, all of that is included. I will say, I don't have this on the slide, but rent paid to related parties has some really technical rules. So if, let's say you have an operating company and you own the building in a separate LLC, and your operating company pays that LLC for rent and you own both of them, you're probably not going to be able to take much rent for that. There's sort of a look through, which says you can really only deduct the mortgage interest paid by the LLC. So if you do have related party rent, you need to dig into those rules and make sure you don't claim rent that you're not eligible for. Utilities, this is pretty much all that you're thinking of, your basic utilities that you pay every month. Interest, so this would be the interest on loans that are secured by real or personal property. If you have any capital leases, they would fall into this category. They're not rent. A capital lease you would treat like a loan, and so you'd only get to include the monthly interest component as a covered cost. Okay, so let's talk about the 4 new ones. So the first one is covered operations expenditures. So it says payments for any business software or cloud computing service that facilitates business operations, product or service delivery, the processing, payment, or tracking of payroll, human resources, sales and billing functions, or accounting or tracking of supplies, inventory records, and expenses. That's a very broad category, so you kind of have to break it down and see what all you're paying for in terms of software expenses and see if they fall into this category. And again, we're looking at costs for these items paid during your covered period. Okay, actually paid, not incurred necessarily, but actually paid with a check, right? Because the whole idea is you have to spend the PPP money on these things, and by spending it, that means actually paying the invoice. So on these non-payroll costs, you have to actually have had paid it for it to count. Covered property damage costs. This is probably not as big an issue in Arizona as it was in other places. And it's just basically related to property damage and vandalism that happened during 2020 that was not covered by insurance. So you can't double dip on your insurance and your PPP. If you got insurance proceeds, you got to take that out of your actual damage costs, and then any excess would be PPP eligible. Okay, this is the hardest one. Covered supplier costs. Expenditures made to a supplier of goods for the supply of goods that are essential to the operations of the borrower at the time at which the expenditure is made and made pursuant to a contract, order, or purchase order in effect prior to the beginning of the covered period. Okay, so what does that mean? Let's pretend that I make pens. Okay, I'm a manufacturer of pens. So when I look at this, what this means to me is it's expenditures made to the supplier of goods. So it's whoever I bought this little rubber thingy from, this plastic thing, the spring on the inside, the ink itself, the little rolly ball, all of those things are my, I'll call them my cost of goods sold, right? Those things are necessary to the operations of me as a maker of pens. So in my case, I would be able to take as PPP costs any expenditure during the covered period, but only for costs that I had under contract or on a PO before my covered period started. So basically, if you do accrual accounting, it's anything in your accounts payable, essentially, at the time you got your PPP loan, or something that you had a purchase order out for. Maybe you hadn't received the item, but you'd order, let's say I'd ordered a bunch of these little rubber thingies. If I could prove that I had a PO in effect on the day I got my PPP loan, then I can include that as long as I pay for it during my covered period. So that's for tangible goods. So let's talk about perishable goods, which is the next part of the sentence. It says, or for perishable goods, the contract, order, or PO may have been in effect before or at any time during the covered period. Okay, so now I'm no longer making pens, I'm a restaurant. Okay. The way I read this, if I'm a restaurant, I can include anything I pay for perishable food during my covered period, right? Because it says a contract or PO in effect before or at any time during the covered period. So all of my food costs during the covered period would count. So now if I'm a restaurant, let's look back to the tangible goods. Let's see, what would be my non-perishable items? Plates, napkins, forks, cups, all of those things, we'll call them pantry items. They're necessary to the operations of my restaurant. Okay, I would have to apply that original rule to them. I would have to have a PO or an invoice at the beginning of my cover period for those pantry items. But for my food costs, it would be anything I paid for during the covered period. So you kind of have to break it down into what you have and which category it falls into. But it's very generous. I mean, if you really think about it, it's extremely generous category. For a lot of businesses. If you're a service business, this doesn't really do much for you. But if you make a tangible product or you're a restaurant, you can get a lot of benefit here. Okay, covered worker protection expenditures. This is basically what you're thinking. Your PPE, masks, hand sanitizer, any modifications you made like plexiglass, sneeze guards, whatever else, whatever you did to your operations to make them COVID compliant would fall into this category. So if you're the masks and the hand sanitizer are probably the biggest cost that people can pull in here, but that is included. Okay, so once you have all your costs captured, you have to evaluate the components. You had to spend at least 60% of it on payroll, which is generally not a problem for everyone. And if you don't meet the 60% test or you don't spend all the money, there are reductions. So you can get full forgiveness if you don't meet these tests. And here's some example of those. I'll let you go back to those because they're not super critical. But so the forgiveness amount at the end of the day is the lesser of the following three numbers. And you'll see that at the bottom of the 3508 EZ and the 3508. It's the total spent on all your covered costs minus your wage reduction, which we talked about, times your FTE reduction quotient, which if you have a 20% reduction in FTEs, then your FTE reduction quotient is 80%, okay? The second number is your PPP loan amount, and then the third number is your total payroll costs incurred divided by 0.6. That's just a mathematical formula to make sure you met the 60% requirement. It comes up with these crazy astronomical numbers on the actual application, which are kind of deceptive. But basically, they're just trying to apply all the tests in the rules to make sure you get the forgiveness amount you're supposed to get. Okay. So the rest of the slides are on employee retention credit, which is not really what this session is about. So I'm going to pop to the questions and see if there's anything else we need to address here. Okay, I think I answered a lot of these already. Do the forms on forgiveness apply to EIDL loans? Okay, so EIDL loans are not forgivable. Okay, an EIDL loan is a loan just as if you'd gone to bank down the street and got a loan. Okay, the EIDL loans have very generous terms. The interest rate is what, 3 3/4 or 3, I think it's 3 3/4%. And then the amortization term for most of them is 30 years. So they're very generous loans in terms of terms, but they are not forgivable. You have to pay them back. Okay, so make that very clear. If you got an EIDL advance, not a loan, but an advance, that was something that came out in April, May timeframe of 2020, and it was $1,000 per employee up to a maximum of 10,000. That is a grant, and it's literally a grant. You do not have to pay it back. You don't have to fill out any forms to justify it being a grant. You just receive it, you call it income. Excuse me, it's actually non-taxable. And then you move on. So make sure you understand whether or not you have an EIDL advance or an EIDL loan. And a loan came with a loan document that you had to sign electronically. And when you received it, it literally looked like a loan document. So you do have to pay that back. Okay, can you please explain the optional coverage period? If a pay period started before the funding was paid out after the funding, does the cover period begin on the funding date? Okay, so there is this concept in the rules about alternative payroll covered period. I have not seen anyone who needs that anymore with the 24 weeks that you can include. So I think the first thing you should do to try to just make it more simple is pick your 24-week cover period, which starts on the day you got funded, and just include all the payrolls that were literally paid after that date and before the end date. Okay, so let's say I get a loan. Let's say I get a PPP loan today, and today's payday, I can include that payroll. Okay, even though all those wages were earned before I got my PPP loan, doesn't matter. As long as the payroll is paid on or after the date that I received my PPP loan, it's an eligible cost. So I think instead of trying to figure out all the weird stuff with the alternative payroll covered period, I would just start with cash method and see if you get to where you need to be. And then only if you don't get to where you need to be, start trying to figure out the accrual basis method. Because the cash method gets most people where they need to be. Okay, single member LLC that files as an S Corp does not show any owner comp and does not show any qualifying figures. Has there been any discussion to be able to use total income? Okay. So if you're a single member LLC that files as an S Corp, in most of those situations, those shareholders are taking a salary, a W-2 salary. At least the ones I work with do. So if you're not taking a salary, I guess I would talk to your tax advisor on that, because I know there's rules about S Corps paying their owners a reasonable wage and what that means, a reasonable wage. So I guess I would reach out to your tax advisor first about whether or not taking a W-2 wage, if you're filing as an S Corp, is okay. Again, I'm not a tax person. I just know enough to be dangerous, but I know there's weird stuff about S Corps and W-2 wages. Okay, is the SBA working with the IRS to coordinate small business issues? I probably not. I don't know, Brian maybe want to pop in here and answer, but I think a lot of what's going on right now is the SBA and the IRS are just trying to keep up with the legislation that's being kind of forced upon them by Congress. That's just my interpretation. That's not what anyone at the SBA or anywhere else has told me. So I know it's challenging. The fact you're saying they're having trouble processing the form or the check, that sounds about right, because the IRS was closed for 6 months and they didn't process anything forever during COVID. And so there was an article not that long ago that they still haven't processed all the 2019 tax returns that were filed. And then anyone that paid their taxes due, I'm talking about their individual tax liability. You know, if they paid it with a check and mailed it last year, it may not have been cashed for 6 months. So they're so far behind in processing paper data right now. I know it's been challenging to work with the IRS. So, but the SBA and IRS working together, probably not as much as they would like to. So any discussion of automatic forgiveness for a loan under a certain amount in round 2. So no, there's no discussion of automatic forgiveness. The closest you can get is if your loan is less than 50,000, read through the instructions for the 3508S, because you're not subject to the FTE requirement. So basically, if you can just prove that during the covered period, you spent an amount on all those covered costs we talked about, at least equal to or greater than your loan, then you're okay. But there is no automatic. Everyone who got a PPP loan has to file for forgiveness. They have to file one of those forms. They have to do it through their lender. And if they don't get forgiveness, and they're going to have to pay it back. And I've been worried about this for a really long time, that people who got the smaller loans may not realize that there's a paper process they have to go through, that they think it's automatic. But it is not automatic for anyone. Everyone has to do the work and file for forgiveness in order to get forgiveness from the SBA. Okay. All right. Anyone else have any other questions? Anything, Robert, that I missed? I know I talked really fast, but I like to cover a lot of content. And you'll have access to the slides. Lisa will send those out, or maybe she posted them in a PDF that you can refer back to if you have questions.
Excellent. Thank you, CariAnn. Thank you
You're
all
welcome.
that asked those great questions. We had a great discussion. Wish we had more time to get on the ERC. I will remind everybody that just a few weeks ago, we did a presentation on the employee retention credit, and that bootcamp video is available in our archive to go back and watch. I know CariAnn said she's been working on those, so her firm is another option for people looking to process and do the employee retention credit. It is a great opportunity for some additional funds, and it is very complicated. So you definitely want to seek out a professional to help you with that process. Again, Brian, did you have any last things you want to share as we wrap up here?
Well, first, thank you for the invite, and CariAnn, great job. That was very informative. The only thing I would like to add is regarding PPP and the shuttered venue grant, for those who are eligible or potentially eligible for the grant, just ensure that if you are seeking PPP, to ensure that it is complete before you obtain the grant. Just that way you can receive both methods of funding.
Excellent. Thanks for that note, Brian. Appreciate that. And a reminder, Brian is from the SBA. He's from the SBA district office in Arizona. So we appreciate him being on this call as well. Again, want to thank everybody for participating. Want to thank CariAnn for her time and effort to put together a slide deck. The slide deck will be available on our website later today, along with the recording. So with that, we'll go ahead and wrap up. Just a reminder, join us next week, Tuesday morning, 9 a.m. for our boot camp session. And until then, everybody have a great weekend and enjoy this Easter weekend with whatever you may be doing. And we look forward to seeing you next Tuesday. Thanks and have a great day.
Bye.